Welcome, self-storage community. I was able to wrangle Mr. Scott Meyers once again. He's quite busy, especially given the current unprecedented times. But I thought it would be very useful to, I saw some questions being posted around the community regarding lending. So I thought I'd start by asking Scott kind of a big picture question and then quickly get down to what that means to us as individuals looking for funding for self-storage. So Scott, thank you for taking out some time to speak with us.
Oh, my pleasure, Roel. How are you today?
I'm good, thanks. So let's jump right into it. I know you're quite busy. So what's the big picture capital markets looking like considering this COVID-19 pandemic as from a self-storage financing point of view?
Sure. So when we talk about capital markets, what I immediately think of is just how do we get these deals across the finish line? And so we talk in terms of, the capital stack, and that includes, the primary funding. Where are we going to get to, what banks are we going to utilize to fund this, whether it be the SBA or the current banks that may have a mortgage on the property, local banks, credit unions, community banks, savings and loans, being that piece, and then sometimes seller financing. Then on top of that is the traditional capital markets, which are the equity markets, our equity partners. When we do a syndication or when we put together a private placement, we bring in our equity partners. And so, where's their head at right now? And, are they sitting on the sidelines waiting, or are they eager to jump in? And then, of course, the balance of that is any other equity that we may have on top of that, or mezzanine lenders, or transactional lending, or transactional funding. So let's start with the banks. First of all, I mean, the bigger chunk. And what we saw was, typically, like we do as we head into a recession, or if something is cataclysmic occurring in the economy or in the world, and the banks all took a collective pause and they held their breath for a little while. And really about, maybe 3 to 4 weeks, we saw, the CMBS market, commercial mortgage-backed securities, that just shut down, and, a few of those coming back. Good news for us, for just the size of our company and the types of transactions we do, we're not doing a lot of CMBS type funding anyways. And I don't think most of the folks that are listening are affected by that too much. But then the SBA, is, they love self-storage, and they've been one of our go-to sources for a number of years because of the programs that they have for self-storage, which is very favorable. And they were still lending. We still had deals in the pipeline that we're moving through. But, as everybody knows, with the CARES Act, those SBA lenders just absolutely got slammed doing the EIDL and the PPP loans. And so, they're just now, bringing their head back, up to get some air again, and starting to look at opportunities, and taking on some projects and giving us some term sheets and then underwriting. But for the longest time, they weren't even available. That was all hands on deck. Anybody at the bank that understood anything about numbers was put on, the loan program, and getting those back out. Credit unions, savings and loans, these folks that have been lending in self-storage, they didn't, they did take a pause for a little while, but they're back looking at deals again. We did have a couple of projects where we had a term sheet that was given, and then they pulled it back and said, well, we're gonna wait this out a little bit, and before we go forward. And so we had a couple of projects in which we had to pivot a bit. But we went to some of our other brokers, some of our other lending relationships, and we placed those projects, got loans for those projects, and didn't skip a beat. Now, the one thing that did change real well is that the banks, still we're all still navigating through this. I mean, we could certainly look back at past recessions, from 1990, 2000, when the tech bubble burst, and then 9/11 shortly after that. We know what storage does, and we know what the economy typically does in terms of the financing side for both for storage and commercial debt. 2008, once again, that was caused by something different in the market. It was caused by real estate, and we saw what happened and modeled things appropriately. But this one is a little bit different. So the banks don't know exactly how to react. So what they've done is they've come out a little more conservative. So on our construction projects, whereas we used to get 70, upwards, but rare, 75% loan to cost on our development projects, they're backing that down to about 65% loan to cost. When stabilized, they modeled out they were doing their underwriting based upon a 1.30 debt service coverage ratio, or 1.25. They raise it to 1.30. If it was a bank that normally was 1.30, they raise it to 1.35. Existing facilities, instead of amortizing over 25 years, they backed it down to 20. If it was a newer project and they were looking to amortize it over 30 years, they would back it down to 25. So, I call it the rules of 5 or 0.5%. So debt service coverage ratios went up by 0.5. Loan to cost came down 0.5. Loan to value came down 5%. And amortization rates down 5. So, across the board, that's what we were seeing. A little higher prepayment penalties, and on the underwriting of the actual individuals, the banks were really looking under the hood and digging a little bit deeper to find out, from the borrower, from myself and the borrowing entity, they wanted to look at liquidity a little bit closer. They were looking at, globally looking at the portfolio to make sure that this loan and this project wasn't subsidizing some area in our business, whether it be self-storage or otherwise, any other borrower. Where folks just out trying to grab money for something on a property to fund actually something else in their portfolio that was failing as a result of this recession, another business or something along those lines. So really looking a little bit harder at, the underwriting of the actual person as well as the facility. So that's the first piece. The second is, seller financing. We know that because lending did tighten up a little bit, that these sellers, if they were in a position to sell, they knew that if they truly wanted to, and if the buyer, if they liked the price and timing was right, that in some cases they may have to subsidize a little bit of that purchase price with some seller financing, or in many cases, they would step in as the lender, and they would be the 75 to 80%, LTV, that the primary lender on their own property, and do a seller carryback or a seller mortgage and note. And so a lot of folks had to get really good, really quick, both on the buying and the selling side, for these transactions that may have gone by the wayside because the banks took a pause. They had to understand what that looked like. So in all, what we saw then at the end of the day, Roel, is more sellers that we were educating on what it looks like to offer seller financing, which is fantastic for us, because the less that we have out there on on a balance sheet from a loan standpoint for them to see on our credit, that is with seller financing, obviously that puts us in a bigger and better position. So then we move to the equity markets, the capital markets, as which is what I think your question is really about, and that is our private equity partners, the folks that we borrow money from, that actually partner with us, that come in and take an equity position in our private placements, our syndications. So it's kind of been a mixed bag. It's been across the board. Self-storage obviously does extremely well during a recession, and always has. And next, it's always in the top 5. Liquor is usually number 1. Self-storage falls in somewhere behind that. So when people are pulling out of the stock market, they're looking for places to put their money, and sometimes to put it to work, because they want to generate some cash flow. And once again, if you look on the internet right now or anywhere, from past recessions to this one, multiple articles from Wall Street Journal to Forbes to Fortune, all the trade publications on self-storage and real estate in general, all roads lead to self-storage. This is the asset class that shines. It does the best. It loses the least amount of value, and typically does extremely well, because it is needs-based, it is needs-driven. And during a recession, in a period that we're heading into right now, where the unemployment rate is absolutely skyrocketing and there doesn't seem to be an end in sight, well, people are downsizing, and they're moving into apartments, or they're moving back home, and they're putting their extra stuff in storage. Businesses that were shut down, they're putting their inventory, they're putting, restaurants are putting, supplies and other goods into storage. Other businesses that just plain closed up, to wait this out to reopen again, are putting their inventory, their goods, machines, you name it, their businesses into self-storage. When colleges were shut down, we had a rush to self-storage. And then what we'll be seeing now is, again, when the recession gets into full swing, and all of the grants, the loans, the employers that are doing good for their employees, when that money runs out, we'll see another demand, another surge for self-storage. Also add into that, the offices and the buildings that were closed, when people were sent home to work, well, they had to clean out the spare bedroom or the kids' bedroom or the formal living room. And then sometimes, if there were 2 income earners, both spouses worked, and they had to come home and create an office, well, then a lot of that furniture and stuff in their home was sent to storage as well. So this one is a little bit different in terms of the fact that actually self-storage is benefiting a little bit more and a little bit earlier than we had thought. And the development financing, although it's out there, it still slows and not many developers are looking to develop. So surge in demand, lack of supply coming online. Once again, all roads point to self-storage. And so for that reason, we have a whole lot of folks that are shifting their money from Wall Street, from, you know, the big casino on Wall Street. And a lot of these folks lost a lot of money because their money was in paper. And, you know, that just goes up when the stock market goes down. And so these folks are looking for hard assets, and many of them are looking for income producing assets. There's still some folks that were looking for a place to put their money now to continue to build their retirement. So we have a lot of folks from self-directed IRAs that are looking to get involved in our projects, but also some folks that want to get involved in some of our cash flowing projects. So when we acquire an existing facility and we're turning it around, but it cash flows quickly, we have a lot of those folks. So there's really kind of two camps and two types of investors that that are attracted to self-storage and that are getting involved in our projects. So all that to say, along with an answer to your one question there, Roel, and that is we have a lot of folks that are very interested, in a whole bunch of folks that are wanting to get involved, give us money, to partner with us in our projects, for whether it be cash flowing or wealth producing. And so we're fielding a lot of calls, a lot of interest, and we're putting our projects out, and we raise capital via webinar, and the numbers are going up, and the numbers of folks that are getting involved is increased. By the same token, the folks that have been investing with us for years, some of them are also hitting the pause button. They want to see where all this shakes out. And some of them are in a position where they need to hold on to cash, or they just want to hold on to cash just in case, instead of having all of their money in play, even if it is in self-storage that is producing income or is wealth building. So time will tell. We're still very early into this, but what we've seen so far is we've gained more people that have more dollars that want to invest in self-storage than we have folks that are just hitting the pause button right now. But time will tell. It's hard to gauge when we put forth an offering. It's still getting filled. We're getting the same amount of partners in roughly the same time frame, but we just don't know what that's going to look like going forward.
So I guess to kind of give a quick sort of tip from an investor's point of view, what one or two things would you like to highlight that investors need to kind of reposition or be prepared for now, as opposed to, say, 2 months ago, to be able to continue to be attractive to money out there right now?
Yeah. I think right now you need to, well, first of all, you need to believe it yourself. You can't be, if you're trying to convince yourself, then you're not going to be very persuasive when it comes to talking to folks that are interested in investing with you. And so I think that's the biggest thing. You know, there is a lot of fear out there right now, and there's a lot of uncertainty. And, you know, investing, whether it be in a hard asset like real estate that does very well during the good times and even better during a recession, you know, once again, there's still a little bit of reason to pause. And I find myself questioning, okay, what haven't I thought of yet? You know, that could, is there, a single point of, risk that could take me out that I hadn't thought of, or even, make this not perform to the level. And although, I don't know what that is, we still need to be cautious as a result of that. But, if you don't think that now is the time to get in, then you shouldn't be getting into the game and trying to persuade folks to invest along with you. So I think that's the main thing. But right now, and it's just that. I mean, you still need to underwrite your deals just the way you did before. You may want to stress test them a little bit more yourself. As we mentioned, the banks are already stress testing our underwriting for us, and they're being ultra conservative. And if the deal still pencils out and it still cash flows and meets the projections, and it meets the projections that investors are looking for today, then we're moving forward. I'm not saying that everybody else should move forward, because I don't know the position that everybody's in, but if you put some pretty strict underwriting guidelines on right now, while we're in this period that is, well, you could argue that it's even better for self-storage, but, as we head into back into a booming economy again, in the future, if the deal still pencils out right now, then it should pencil out when things return to normal. So all that to say, Roel, bring along, good folks alongside of you. Stress test your underwriting, have somebody else take a look at it and stress test it as well. And then as you're talking to those equity players out there, you need to educate them, point them to the articles and to all the news and the history on self-storage and how well it is doing. and the reasons why they should invest in not only self-storage, but then invest in you. You need to have a story to tell. It's the reason why you're not a good bet, but that you are a proven performer, and that they shouldn't have any worries about investing in you and in self-storage. So it's dialing that story in, but also backing it up with the numbers and the proof and the history of self-storage and the type of project that you're working on.
That's great. Well, Scott, thank you for the updates. I know you're quite busy, and I appreciate your time. As always, sharing your valuable insight with our community. Probably we'll get together again in about 2 weeks' time from now. Anything else before we sign off? Because I know you've got a couple projects on the go.
I don't think so, Roel. Just once again, I appreciate this. Seems to be the most time that we have over the course of a week to be able to get together with as busy as you and I have both been. But I'm just glad that you're doing everything you're doing to share the information as to what we're doing behind the scenes. Here at SelfStorageInvesting.com and within Kingdom Storage Holdings, and keeping Storage Nation informed. So I appreciate everything that you're doing, and to everybody else out there, keep after it, guys. Put that protective fence around your head. Times are good. Self-storage is good. We've got the best story to tell in the economy right now. And so go after it. There's a whole lot of folks that are looking to sell. Just take advantage of those opportunities out there, underwrite well, and go after it.
Super valuable information. Thanks again, Scott. This is Coach Roel and Scott Meyers for our self-storage investing community. We'll see you again soon in a future video very soon. Hey, thanks again for joining us here at Self-Storage Investing. We really, really appreciate it. For more great content like this, make sure to click the subscribe button below this video. And be sure to follow us on Facebook, Instagram, Twitter, LinkedIn, and BiggerPockets. You can also visit us at our main website at SelfStorageInvesting.com, where you'll find even more free content, our ebook, and registration to our free webinars and education courses, and much, much more. Once again, for more great content like this, please click the subscribe button below. Thank you.